Have you ever thought about how cool it would be to get paid just for owning a piece of a company? Well, that's exactly what we're talking about today. We're going to demystify dividend investing, a really powerful way to build passive income. We'll cover what it is, how to figure out what a dividend stock is worth, and crucially, the traps you've got to watch out for.
So, to really see the power of dividends in action, let's take a look back at a really tough time for the stock market, the 1970s. This chart is pretty mind-blowing. It shows that dividends made up a staggering 73% of the S&P 500's total return during that entire decade. I mean, without them, investors would have barely made a dime. It just goes to show you how dividends can carry your portfolio, especially when stock prices themselves are just flat.
Okay, so we know they can help you get through rough markets, but what are the real core benefits that pull investors into a dividend strategy? Why is the simple idea of getting paid to own a stock so powerful?
Well, it really boils down to these four things. First, you get that steady passive income stream, cash flow you can count on. Second, the best companies are always growing those dividends, which helps your income beat out inflation over time. Third, these are usually really stable, resilient businesses that tend to hold up better when the market gets shaky. But honestly, the real magic, the secret sauce, is compounding. When you reinvest those dividends, you start earning money on your money. And that creates this incredible snowball of growth over the long haul.
All right, now let's talk about the absolute gold standard for dividend consistency. We're talking about an elite group of companies known as the Dividend Aristocrats. Yeah, the definition here really tells you everything you need to know. First off, you have to be a big, important company in the S&P 500 just to get in the door. But the real test, the thing that makes them aristocrats, is that unbelievable track record, increasing your dividend for at least 25 straight years. That's just a massive vote of confidence in a company's strength and its commitment to its shareholders.
And that number, 25 plus, that is the whole key. I mean, think about that for a second. Think about everything that can happen in a quarter of a century. We're talking recessions, market crashes, global pandemics, you name it. A company that can get through all of that and still give its shareholders a raise every single year is telling you something profound about its financial health.
Now, here's an important point. Just because a company pays a dividend doesn't automatically mean it's a great buy. So how in the world do you figure out if a dividend stock is actually a good value?
One of the classic ways to do this is with something called the dividend discount model. And it's a simple idea, but it's really powerful. It basically says that a stock's true worth isn't its price tag today. No, its real value is all the cash it's expected to pay you in dividends for the rest of its life, all added up. You're not just buying a stock, you're buying a future income stream.
And this formula, which looks a little intimidating, actually tells a pretty simple story. It says a stock's price, or P, is driven by its next dividend, D1, and what you expect as a return, R. But the real powerhouse in this equation is G, the growth rate of that dividend. Seriously, even a tiny tweak in what you expect that growth to be can have a huge impact on what the model says the stock is worth.
But, it's not all sunshine and passive income checks. Dividend investing has its risks, and sometimes a really high yield isn't a gift. It's a warning sign. There are some common traps you absolutely have to learn how to avoid.
And this quote just nails it. A dividend cut is what we call a double whammy, and it hurts. Not only does your income stream suddenly shrink or disappear, but the company's stock price almost always tanks on the news. So that high dividend is totally worthless if the company can't actually afford to keep paying it.
So how do you tell the difference? Well, a safe dividend is like a healthy tree. It's supported by deep roots of growing profits and good financial health. A yield trap, on the other hand, it looks really tempting, but it's a Venus flytrap. It's often hiding a business that's in real trouble, with too much debt or falling profits. And don't get fooled by a long history. Companies like L Brands and Owens & Minor paid dividends for decades right before they had to cut them. You've got to focus on the health of the business today.
Okay, this next trap is a tricky one. It's more of a psychological trap, and it trips up even really smart, experienced investors. It's called yield on cost, or YOC, and man, it feels good, but it can lead you to make some really bad decisions.
And this story about Emma just illustrates the problem perfectly. So Emma saw she was getting a 35% yield on what she originally paid for the stock, and she was furious that her manager sold it. But here's the thing, the stock's current yield was only 7%. The manager sold that to buy a different, better company that was paying an 8.5% current yield. The lesson here is so important. Make your decisions based on your best opportunities right now, not on a backward-looking number that just makes you feel good about a past decision.
Okay, so let's pull all of this together and talk strategy. For a lot of people, the easiest way to get started and make sure you're diversified is by using exchange-traded funds, or ETFs.
And with ETFs, you can pick different approaches. One like VIG, for example, focuses purely on dividend growers, so solid companies that have a history of raising their dividend for at least 10 years. Then you have something like SCHD. It looks for a high yield, yes, but, and this is crucial, it runs those companies through a quality filter. It checks for things like strong cash flow and good return on equity, basically all the signs of a healthy business that can help you avoid those yield traps we just talked about.
All right, last but definitely not least, you cannot build a real strategy without understanding how taxes work. This is a huge piece of the puzzle, and the good news is it often works in your favor as a dividend investor.
And here's why. Most dividends you get from U.S. companies are what's called qualified, and that just means they get taxed at the lower long-term capital gains rates, not at your regular higher income tax rate. And as you can see from this table, for a whole lot of people, that tax rate could be 15% or even 0. That is a huge tax advantage compared to other kinds of income. So there you have it. We've talked about the power of dividends to give you stable returns, the elite status of the dividend aristocrats, how to spot those dangerous yield traps, and even how you can build a diversified strategy. So the final question really is for you. When you think about your own goals for income and for growth, how does a dividend strategy fit into your personal investment journey?